Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Happy Easter weekend, everybody. I've got a question for you. Did the markets bottom? And now we just had a 2-day follow-through, maybe going on a third? Or is this an April Fool's joke and a dead cat bounce? How will you know? Well, that's exactly what we're going to talk about. But first, a few mailbags that we got just a few days ago when the market was actually pulling back pretty hard, right? And it's just like this shirt I have on the back. It's not what you make in the market, it's what you can keep, okay? Now, this is 328 from JK. You're doing a great job managing risk, man. Greatly appreciate it. It's great to be up on a day like this. Not many people are in that position. 4-1 VG, a turbo client, a doc in California. Man, you guys have absolutely been killing it with the drawdown protection defense short positions. Really happy I have to have my retirement in your hands. Incredible work. 330 MB. It is reassuring to see how well the Revere team is managing our portfolios during this Iran crisis. And then he put a article in about why the Iran crisis could last far longer than anyone wants to admit. We don't care about far longer. Price is true. Just remember that. 3-1 S, and I don't have his last name. Yep, that's his first name. And this is when Don did an IBD Founders Club presentation just a little while ago. Hi, Don. Great job last night in presenting to the Founders Club. It was an outstanding presentation that I'm sure all the members gained a ton of your valuable insight. I know I did. In addition, I have really enjoyed your team's YouTube videos. I can confidently say you and your team are putting the best content in the CanSlim space. In fact, I watch your team's content each night before I watch the IBD content. I appreciate your team putting out the content and will continue to enjoy. Then Don answered, on behalf of the team, thanks so much for the kind words. Keep hitting that like button on YouTube. Just search for Revere Asset. And tell your friends about us. Thanks again, Don. Now, this is the key right here, folks. This was Don's comment on, I think it was yesterday, Don, on Twitter or the X.
After the close.
Yeah. Because we got 2 days of follow-through after kind of a little meltdown in the market. We went down less, but the market got hit pretty good. Anyway, Friday we got calls from clients wanting to completely exit the markets today. Today we got calls from clients wanting to buy. In both cases, I explained that at Revere Asset, our process and how it's time-tested to thrive and survive in all market conditions. Folks, that's behavioral finance. That's why your risk tolerance is not quite, if the market's going up, everybody wants in. When the market's going down, they all get scared. How do you quantitatively measure that instead of using your emotions? Remember, price is truth, no exceptions, period. So the markets were selling off earlier today, and so I'm sure people were scared. Now I think they've come back to about, well, Don will talk about that, right? So with that, let's go to Obi-Don Kenobi, and he can explain all these things I just brought up in our process, because the market's been choppy right now, and that's when it's tough. When you're just in a primary uptrend or a primary downtrend, it's easy. But when you kind of get sideways and choppy, it's a little tougher. So Don, take it away.
Thrive and survive, Dan. That's
there you go. There you go.
You know I love alliteration and poetry. And by the way, if it doesn't rhyme, it's not poetry. So looking at a weekly chart here, the S&P, we all want the market to take off the way it did in late 2023, like an Artemis rocket to the upside, right? This is the condition under which bulls will thrive. But then you got to be able to survive the pullbacks, especially if you get close to retirement, because you never really know how long they're going to last. 2022 was a brutal one. That was a bear market because of the inflation scare. 2025, April-ish, was the Trump tariff scare. We came out of that following our follow-through day rules, and Todd's going to do a presentation on that, very timely for that, before we took off to the upside again, but kind of stalled out. The NASDAQ 100 stalled out in October on a relative basis. The S&P topped right above 7,000 in January of this year. And then we just started rolling over, breaking our different moving averages. And I posted over the past couple of weeks the rules that we have for index allocations as we start to break below moving average. But we've also got rules for getting back in, and these are called RARE rules, Revere Aggressive Index Reentry rules. And this was based on some studies of how we re-entered the market and how we can do better re-entering the market based on the individual action. And basically what we're looking for is when we're under the 200-day is certain different types of behavior to start our index allocation back in. If we're trending lower, grinding lower, which has really been what we had been doing up until the action of Tuesday, we really are targeting zero because we're just trying to wait and see what the market is going to do next. Now, sometime it has a massive oversold shakeout. This is a panic that gets rid of everybody. We didn't have that this time. It was more of just a grind lower. Obviously, there were some massive shakeouts in some individual names, but we're talking about the half of our portfolio that we use as a cornerstone to catch all the sector rotation and to smooth the equity curve. So we didn't get that. But on Tuesday, we'll look at that with the big up day. This was just an oversold bounce. The market had been doing kind of a 3-day down bounce. Here's 2 days down. This was a 3rd day down and then a hammer. This was 3 days down, 4 days down, and then 2 little up days, then 3 more days down, a little bounce that ended up resulting in 3 more days down, and then yesterday's bounce, and Tuesday's bounce, and then Wednesday's bounce. Where did they pause, and where has today's bounce paused? Right into the declining 21-day moving average. That's the green line on here, and that's a key level for us. We use it both on the upside when we're in Artemis rocket mode, and we also use it to the downside when we're in re-entry, plunging back to the Earth mode. So first, this purple line, the 8-day exponential moving average, we got back above that for the first close on Tuesday, a little bit of follow-up strength on Wednesday. On that follow-up strength, because we want to, one day is just an aberration. You need follow-through. It can be just an aberration. You need follow-through one way or the other. So we started on the reclaim in Grotection. Turbo is a little bit different. They are running more of a long and short portfolio now. They can be more aggressive. They have more leeway to enter and exit the market. Still, half of the portfolio is still dedicated to the indexes, but they can be more patient when they re-enter. But in the Grotection, and this is why Turbotection and Grotection are good complements to each other. Sometimes one's zigging when the other one is zagging. And Ted and Connor have been doing a fantastic job running a combination long, short, holding 2 of the best names that continue to show relative strength, and shorting a bunch of up to 6 names now that have shown relative weakness and weak bounces into declining moving averages. That's our preferred way of shorting. It's not on a plunge to the downside where you can get run in by a day like Tuesday where you snap back to the upside. So on Wednesday, we started to peel off We also run longs and shorts on the protection side, and I've explained this to several clients because they question, why are we holding the same instrument that's an S&P instrument, both long and short? And the reason is it's psychologically easier to maintain the long position, and it also doesn't trigger a taxable event for clients that we have with large gains on the cornerstone position, either the 1-time, 2-time, or 3-time index ETFs. So what we do instead is just, if we want to hedge, we just put an equal short on for however amount of beta we want to neutralize. So you can be 40% long S&P, 40% short S&P if you want to get your target to zero. And that's basically where we were at the end of day Friday. We were, for the most part, out of the market. And then, as I said, Tuesday, Wednesday started to add a little bit back, but we failed into the 21-day moving average right now. This is actually a preferred place to short, or to put shorts back on if you're failing into the 21. It's the most low risk. But we're going to play both sides, taking long risk off and taking short risk off. Really, if we break back below the 8-day moving average is when we'll go more to the short side and actually end up being net short. But overnight, Trump had a speech Wednesday night. The futures hated the reaction to it because it seemed to be prolonging the war. No plan to open the strait. And we gapped down 1.2% at the open today, but we put in the low within the first 10 minutes. Around 10:45 today, a news item was floated that Iran is working with another country to draft a proposal to open the Strait of Hormuz, and the market shot up. It shot up to basically near flatline, near inside yesterday's trading range, and it's just been going up and down about 20 basis points. We're basically about flat right now, waiting for a decision on, is this going to be something real, or do we really want to take risk off into a 3-day weekend when we really don't know what could possibly happen on the geopolitical front? But what we do know is that we twice in a row have been unable to get above this declining 21-day moving average, and that's what's pausing us from putting more risk on. So look at these different criteria we have here for re-entering. Above the 8, above the 21, an 8 above the 21 cross. We really want to see this. This shows that the ultra short term and the short term have flipped from bearish to bullish. And if we get back above the 50-day moving average, we'll keep putting more on. And this can happen. This is designed for even if we're under the 200-day moving average. But if we get back above the 200, we're going to challenge the 50 because the 50 hasn't broken below. So these rules can be applied whether you have just a less than 10% pullback, but you're more than 2 ATR below the 200-day moving average, which is what we saw at the end of last week, or they can be, and just that first bounce, just play it the same way. Or it can be like we were last April, where we had a 20% sell-off and we used very similar rules to get back in. So that's how we're playing it right now.
The market, hang on, the market had a 20% pullback. We were down like
the market, not I always
we were down a third as much.
The market.
I just want to make sure we clarify.
Absolutely right. Thanks for clarifying that. I do that all the time.
I know.
And I'm not going to be able to break that habit no matter how hard I try, because I say we were.
That's why I'm here. I got to put my Don interpreter on.
I know, Dan. You got to keep me straight. That's right. That's right. So that's a key level right now, is the declining 21-day moving average on the S&P 500. That level is about 66.07. Today's high, 66.02. Yesterday's high was 66.10. And the 21-day moving average was at 66.11. It's still declining, but it's starting to flatten out, which is a good thing, because we want this 8-day to come up through the 21 to give us more confidence on the long side. And again, this little 2 ATR range below the 200-day moving average, this is designed to not let us get too bearish. You can also notice that the slope of the 200-day moving average is still adding a couple of points a day. If it flattens and rolls over, you go back to April of last year, and Todd's going to talk about follow-through days. Actually, it was 2022. He's gonna talk about, and we ran into a bounce into the then declining 200-day moving average, and then the market made its biggest move to the downside. So short-term rules to determine how long we're going to stick around below the 200-day moving average. We get out, then we flip to these aggressive reentry rules using the 8 and the 21 to get back in. And then we also, at the same time, are going to be looking for the classic follow-through day, which led us off the lows in April of 2025. And we really have more stocks to pick from now than we did back in April of 2025. Most of the leaders got completely decimated. We're still producing a 21 over 21 and a Turbo 12 list because there's enough quality fundamental names to keep publishing it. We expanded it a little bit to include those that were just below the 21 but held the 50-day moving average, because the 50-day is a key support level as part of the O'Neill concepts, and it's actually a spot to buy good stocks on a pullback. Normally that pullback is happening when the market pulls back, but not necessarily this hard. But again, the rules, apply the rules as the situations occur. Just the important thing is to know the rules, not break them, and above all, never lose big. If you're wrong, reverse, get out right away, and keep your powder dry for when the market winds are fully at our backs, and then the market is taken off like that Artemis rocket, which is really what we're all waiting for. But patience is extremely important. Not getting chopped up is extremely important. I haven't owned any individual names over the last week after closing Fastly, the last piece of Fastly on Friday. Ted and Connor running more long and short portfolio and have been doing fantastic. Ted will talk about the names that they're short. I'll talk about the one name that I'm holding short. That's Oracle, using ORCS ETF. You always use the underline to make your trading decisions. And in this case, it has wedged up into the declining 21-day moving average. It's basically flat today, and that's where I initiated a short using ORCS yesterday. And if somebody's going to look at ORCS and say it trades very thinly, I want to remind you it's not a stock, it's an ETF, and the market maker and the issuing company will create the shares as needed for people like me that want to short the stock. With the underlying Oracle being extremely liquid, you can see this is a $416 billion company. It trades 29 million shares a day at $145. Extremely liquid. Basically, the market makers that are issuing ORCS are taking the short side of Oracle, and that's plenty liquid. So there's no issue there with liquidity on ORCS. So that's basically the playbook, is taking opportune shorts into declining moving averages in a weak market. Because as we know, William O'Neill says very clearly, one of his rules, and you see it over and over and over again, is that the average leading stock pulls back 72% from its highs when it finally tops. And we now have instruments to be able to take advantage of that he didn't have. And with us having over 60% of our client accounts in IRAs, it's great to be able to go short, because you can't short in IRAs, but you can buy
individual stock. Individual stock.
Yeah, individual stock ETFs.
And so the fund actually shorts the stock for you, right?
Correct. So back to the S&P, that's where we are. I'll go to the SPY to get an up-to-date 5-minute chart, and you can see since this sharp move up, we've just been consolidating in a very tight range, neither bulls or bears getting the upper hand, below the highs of Wednesday, and see which way this consolidation may resolve one way or the other by the end of the show. It's 3 minutes before noon Eastern time on Thursday. Obviously, the market being closed for Good Friday is why we're doing this on Thursday. So, Dan, any questions on that approach?
Yeah, pull up the S&P chart real quick. Okay, right there. You had it. Okay,
That's
well,
right.
that's fine. That's fine. So, folks, I'm not talking to the technical traders, the stock nerds. Excuse me. I'm talking to the people that are the retail clients. The pie charts are us that came over from, well, wherever. You can pick Ray J, Ed J, it doesn't matter. Fidelity, whatever. When they give you a basket of mutual funds, right? What those moving averages, so the green line is a 21, the black is a 200-day simple moving average, and the red is a 50-day simple moving average. So if the green line starts to tick up and especially slice through one of the longer term moving averages, that's telling you that momentum in the short term is increasing, and it probably is a good time to buy. And if you get a little pop right away early on the first week, then you got a little bit of a buffer. Okay? And Don always says nothing happens below the 200. Nothing good happens below the 200-day moving average. All bear markets happen below the black line. That's why we're being tentative right now, because we're below the 200-day simple moving average. And the 50-day, that red, you really want to start seeing them curve up. The rate of change, the slope of the line, the second derivative, actually when they flatten out and start to hook up, that's also a good sign. Anyway, I just wanted to clarify that for the lay people that aren't the stock nerds. We've got a whole bunch of clients that are stock nerds, and we've got a whole bunch of clients that came over because they were tired of losing 35% in the last bear market. So anyway, go ahead, Don.
All right, so let's take it over to the tech team for our presentations, and we're going to start off with Ted. We're going to quickly show the 6 names and it's really the same setup that we're using. He's going to show the 6 names that TurboTection currently has inverse ETFs, single stock ETFs, so that we can play it for all clients to the downside. Take it away, Ted. We want to start with the quantums.
Thank you, Don. Yeah, let's just do quantum since I did it last week on the pod. Just a quick review. Again, we took IONQ with IONZ, RGTI with RGTZ, and then QBTS with QBTZ. IONQ and RGTI were started on the 17th of March, and QBTZ or QBTS was started on the 18th. I mean, like Don said, the short setup was pretty simple. There's relative weakness in these names. They were in stage 4 downtrends below the 200-day, 50-day, 8 and 21, just trending nicely below, and the markets were cracking at the same time. So just bought it against the moving averages and pretty much have rode the trend down. 3 days ago, or 4 days ago on March 30th, we had those 3 to 4 days down in a row, like 3 days down in a row, and our positions were up 3 ATR. So around 45%. So we decided to trim 50% of it off, just to lock in some profits. Just to, you're up a decent amount. Shorts, the rallies during correctional periods can be very vicious. And we had 2x ETFs that were 15 ATR. So just wanted to take some off the board, and now we're riding the rest.
ATR, folks, is average true range, the range of the stock on an average, a daily average. So if it moves 3% a day on average, that's what he's saying.
Yep. But we have some other shorts that are pretty much break even, maybe slightly green. So not everything is extremely successful. These quantum names have given us some decent profits, but if we take a look at NVDA, this has definitely given us some frustration. We first took a position on March 19th. It started seeing some fall through the following day, and then it almost shook us out on March 25th when we broke back above the 200-day moving average, but it was rejected at the 21 EMA, and so we were able to stay in position. We had 3 days down, didn't decide to cover anything because there wasn't really an area that it just looked like it was going to continue downward. But again, you just never know in these markets. And right now we've rallied back up to around our cost basis, but it's still below the 21 EMA for now and yesterday's highs. So we're going to stay patient with it. 200 days above as well. That's starting to flatten. And then the 50 days above too. But if this were to break back above the 200-day, maybe back above that 180 level, we'd likely cover the position for a small loss. And for all these shorts, we didn't size any of them extremely big just because of the volatility in the markets. So the next one, also in the semis group, AVGO, we took this on the breakdown. If you draw an upper trend line, you can see that if you draw an upper trend line from 295, 307, yep. We took this one on March 26th. It worked for 3 days, but now, again, a little bit of frustration, pretty much back to our cost basis, maybe up like 10, 20 basis points right now. But we're going to stay patient with it. It hasn't hit our stop, which is in the 320 to 327 area. There's a lot of resistance above, too, with the 21 EMA declining 50, which actually death crossed recently below the 200-day. And the death cross is when the 50 closes below the 200-day moving average. So again, we have the upper trend line, we have the 21, we have a lot of overhead supply and the 50, so we're going to give it some time, even though it's giving us a little bit of frustration here. And then, I mean, all the short setups are pretty similar. It's a stock that has ran quite a bit, saw some big breakdown, has gone sideways and can't get back above 50 and some other key moving averages, breaks below the 200, and ideally we short that first breakdown of 200, but like the quantum names, we didn't catch the first breakdown, so we took a continuation setup after the first base formed below the 200-day moving average. And then the final one is Bitcoin. It's actually relatively weak today, even though the market's briefly turned green. This is still down 1.85%, and you can see it's very similar to quantum as well. I initially started this on March 30th, just a few days ago. Added a little bit on March 31st, but that day ended up closing at the highs, but it didn't hit the stop. Yesterday it almost stopped me out, but was rejected at the 21 EMA. And right now we're back in profits here, only up like a few percent. So very similar short setups across the board, looking at bear flags within downtrends that are showing relative weakness to the markets. So that's just a quick update on our short positions. And then like Don said, we're still holding fastly from the gap up and TR from many weeks ago, multiple months ago. So as long as those keeps us in, we're willing to stay long short. And when you are running long short, you really have to listen closely to the feedback on the long and short side, and it can really push you to go either direction, depending on what the action is. For example, we start getting stopped out of some of our shorts or trailing shorts, that could tell us that maybe the market's starting to firm up again. We're always tracking relative strength during corrections, and there are a lot of stocks and bases, so we're keeping an eye on relative strength, relative weakness, our longs and shorts very closely, and then see what the index do as well.
All right, good stuff, Ted. Let's flip it over to Connor right now, and he's going to take a trip back to 2022 on the S&P 500. We're going to set the date to a year after the carnage really started to happen in 2022. We're going to bring up a weekly chart here. This is the 2022 bear market. Take it away, Connor.
Yep. Yeah. So today I wanted to talk about counter trend rallies and quote unquote bear market rallies. And, Wall Street defines a bear market as a drop of about 20% or more from the peak. But by that time, you're going to want to be defensive and already in heavy cash by the time it's, quote unquote labeled as an official bear market. And typically these are always going to happen below the 200-day moving average. And so 2022 is a good recent example of just the markets don't move down in a straight line. And if you go to the daily chart, Don, we're going to walk through a couple of the bounces that transpired throughout this period. And yeah, you can just put it to perfect. And so the market topped in January of 2022 and got below the 200-day moving average. And you can see the first bear market rally that took place that was in March. And this roughly went from 4,100 all the way up to 4,637. And again, this is why it's crucial to stay nimble in these types of markets, because if you had short positions on, that rally is going to blow you out of all those shorts. And so we can see, when did this, what were the characteristics of this chart that kind of led to that. And you can see what Don was talking about earlier is you see the price gets back above the 8 and 21 day moving average, and then you get, a very tradable move from 4100 all the way up into 4637. And then this fouls, it rolls back over the 200-day moving average, and then you get the second leg lower. And then the next powerful bounce that occurred here was the rally in July, and this was from 3,800 all the way up into, that was about 4,300, and look where it paused, right at the 200-day moving average. And this one again had very similar characteristics. You had the 8 getting back above the 21 EMA, you had price crossing over those lines as well, and you also got above the 50-day moving average also. So in that moment, you could have thought the bottom was in. It's always hindsight after the fact, you never know. But right when the S&P 500 got rejected right at the 200-day moving average, and then it started to roll over again. And really, this was and then the final rally that was the low occurred in October, and that was from 3,500 to about 4,100. If you just move it to 2023, Don, so it can show the picture. And yeah, so that was another really tough rally that rolled back over again, but then put in a higher low, and then started to and that was the bottom and confirmed into the 2023 bull market. And during these times, there's always a lot of FOMO, there's always a lot of fear, and that's why it's super important to stay nimble. And when you look back at these periods, you can do 2001, you can do 2008, and they all have very similar characteristics. You don't need to be the first one into the market. The best action happens weeks after the low, and it's just more of an ego thing, thinking that you have to catch the low. So, when you look back here, some of the main characteristics that stand out is, number one, S&P needs to get back above the 8 and 21, and then preferably the 8 is over the 21 EMA as well. And that's why we have those rules for aggressive index reentry. And then also looking for volume characteristics, and then also the action of leading stocks is also another good way to add evidence that maybe the market is putting in a durable low. And then also combining breadth indicators. When you get those super washed out breadth readings, that can be typically a good sign. We talk about these in the nightly videos as well, like the percent of stocks of the 5-day moving average. And so those are some tools that you can all add to your toolkit to add some confluence that maybe there is going to be a short-term rally. And that's why these downtrends and periods of chop in the market can be very difficult, because you never want to be too short and you never want to be too long, because the market can move very fast. But being able to recognize if it's getting exhausted to the downside, having some rules, having some precedents for getting back in, and then also knowing that if you are below the 200-day moving average, the rally is more likely to fail, and being able to get out if you're playing the tradable bounce. So 2022 is a really good just a really good example. But you can look at 2008, 2001, and various other bear markets to see how vicious the rallies can be.
I want to be sure to point out some nuances here on that first rally, Connor, because I talk about that 1 to 2 ATR below the 200 to see if we're going to recover, or if we're really going to blow wide open. This first trip, 5 days, 6 days under the 200-day moving average, we recovered it. We recovered the 8, we recovered the 21, but the declining 50-day thwarted it twice. And also notice the purple line, the 8 EMA, never got back above the 21-day moving average. You never had that cross. So using that rule that we have to avoid plunging without verification is critical. Got close and failed, got close again here with a hard rally up into the 21, never crossed above. And then finally it did cross above, got a little bit of a tradable rally here, back 8 above the 21. They both cleared back above the 50-day. But then also notice that the 200-day slope was still slightly rising until this day right here. This is right where we flattened out. We tried to get back above the 200. We failed, and that was the beginning of the second leg down. That account, and then again, rally right into the 200-day moving average, third leg down. So these little subtle clues, and then finally, as Connor pointed out, we bottomed in October. This was a very critical day. We had a massive news failure. CPI came out, and it was extremely inflated, but the market put in a bottom right at that 3,500 level, put in a big hammer candle, and that was the beginning of the bottom and a very tradable rally that ultimately ended up in new highs to the market. A lot of subtleties within these patterns, and just stay in tune with us, and we follow them. We report on them every night on our videos, and you'll notice several times, this is something Ted and Connor really have been talking about strongly on our team calls this week, is waiting for this 8 to get back through the 21 before really pounding the indexes and the individual stock longs, because we know that the 75% of the stocks are going to move in sync with the overall market. We've had some standout leadership, but those standout leaders can be up 9% one day and down 9% the next day when you have a high volatility regime like we have right now. 1.59% ATR on the S&P. We prefer it to be below a 1. So also look for declining ATR on the S&P 500. We haven't seen that yet. Great job, Connor, covering that. Anything else you want to add?
Yeah, and just on the topic of the 8 getting back by the 21, if you just go to the tariff low as well, and again, in real time, the volatility is crazy. People have huge FOMO because the market's really moving. But when you look at that bottom, once the 8 got back above the 21 and sloping up, that is when, quote unquote, the easy money was made, because, you bottomed and then you put that higher low in, but you could have saved yourself some headache just waiting for that signal that you got right where where the line's pointing. And then it was smooth sailing for the next couple months.
Yeah, look at that. 8 stayed above the 21 all the way through October, from April to October. This is the Artemis action that we're looking for. This is when we really want to put the pedal down, take advantage of the action in leading names as well as the indexes. Great stuff, Connor.
Money is not made evenly, folks. That's what you got to realize. There's surges in uptrends, downtrends, and then occasionally you'll get in a sideways market for 2, 3, 4 months.
Yeah, pie charts will be under-invested in strongest markets and over-invested in the weakest markets.
Mm-hmm.
Todd, you got to talk about the follow-through day concept. So let's hear what you have to say.
Great. And I know all the IBD purists and stock nerds already know this, but this is for our new clients or clients that really aren't familiar with the IBD rules. The follow-through day concept is a classic Bill O'Neill rule, and it was very beneficial to me, which I really started taking on the IBD methods in 2009. And basically, we're in a correction right now, and in order to be on a follow-through day watch, we must be in a correction, and all the major indexes are below all the key averages, so we're obviously in that situation.
The markets are in a correction. I just want to clarify.
Correct. The markets are.
We're not.
Right.
Well, we are, Dan. We pulled back from the highs, but we haven't.
Well, yeah, but classical definition is 10%. But go ahead.
Yes.
Right. Correction I'm talking about is an IBD correction.
Right. Okay. Got it.
The market itself is in the correction phase of IBD vernacular. So right now we're on follow-through day watch. On Monday, we made the low, and that starts our count. The next day, Tuesday, is day one of a rally attempt because we did not break Monday's lows. Okay, yesterday we made another day of positive direction without breaking the lows, and today we're looking at what we call day 3. That brings us into Monday, which would be day 4. Day 4 qualifies as a potential follow-through day. Now, why did Bill O'Neill do this? Because oftentimes the first couple days of these big rallies off the lows are short covering rallies, and institutions are just sitting back waiting for an opportunity to resell. And so far, we are running into that declining 21-day moving average, and we're below the 200-day moving average. So the jury's still out whether this is in fact a potential bottom, or whether Monday, Tuesday of the upcoming week, we could get a follow-through day. Now, what conditions need to take place for us to see that follow-through day? Monday would have to be an up day on bigger volume than today's volume. And we have a percentage requirement as well. Generally, for the S&P, we want to see 1% to 1.25%. Okay, NASDAQ a little more because the NASDAQ's more volatile. We want to see more like 1.5% on the NASDAQ or more. So if Monday's an update in those percentages on bigger volume than today, we would consider that a follow-through day. And generally speaking, Bill O'Neill liked to buy a couple of the leaders on that day, whether they're breaking out or showing extreme strength. One of the nuances, too, we like to see is on day 1 of the rally attempt, and this is me personally, I like to see big strength on that first day of the rally attempt. And Tuesday definitely showed that. We had an open equal low, which means that all the indexes opened at the exact lows of the day. And we closed really at the highs of the day. And Don's showing on the intraday chart here that we never broke those opening lows. We opened at the dead low on really all the indexes and closed pretty much at the highs. So that was a very powerful day 1 rally attempt. And that definitely helps lend some credence in a potential follow-through day being more successful. The other thing Bill O'Neill liked to see is he wanted the follow-through days to typically occur on day 4 through 7. So relatively early from that bottom. Does not want to see that follow-through day occur days and days after that, because all you're doing is wedging potentially, or bear wedging. So at this point, we did have a very strong day 1. We are below the averages, but we do have some leadership stocks that are holding up very well. And if we get the right conditions early next week, we could see potentially a successful follow-through day attempt in the market.
And like Todd said, day 4 is Monday, with the markets being closed for Good Friday. Also Friday, we have a government non-farm payroll, highly watched piece of economic data coming out. So we'll have that to digest over the weekend, as well as any news coming out of Iran. Thanks, Todd. Dan, that's everything from the tech team. You can go ahead and wrap it up.
Folks, I just got a question for you. Does your advisor sound like these guys with your money? By the way, that's the name of our podcast. It's not your money. It's your money. It's not Wall Street's money. Wall Street thinks it's their money, and they want to spread it out amongst all their real clients, the municipalities, the growth stocks, the government treasuries, and small cap, mid cap, whatever. That's why they came up with a modern portfolio theory, and you just sit there and just take it. Just hope it's going to be all right. The real science is a sequence of returns, your actual returns over time. Compounding works both ways, both on the up and down. Listen, if you like what you heard, just tell a friend, tell a neighbor. Just go to revereasset.com. In the right-hand corner, there's a subscribe button. Next to that, there's a Contact Us button if you want a complimentary portfolio review or want to become a client. You can also go to YouTube and just type in Revere Asset and hit the like button. Zach, our producer, is going to have this out within an hour after we record. Our newsletter on the website actually goes out the next morning for the podcast, because we normally record it on Friday for Saturday delivery. So there's a bunch of different ways to get our content. And you can always call us at 855-REAL-WEALTH. We'll talk to you next week on Your Money, not Wall Street's money, your money.
It's not about how much you make in the markets, it's about how much you can keep.